Let's now add a small layer of additional complexity to our series and look at a lease that includes incentives, both before and after commencement. We'll walk through how those incentives affect the lease liability, the right of use asset, our initial measurement, and the subsequent monthly accounting. Now, before we turn to a real-world lease, let's quickly refresh what ASC 842 says about lease incentives. We touched on this earlier when talking about what qualifies as a lease payment, but only at a high level. If we look again at ASC 842 1035, it states that at commencement, lease payments consist of payments related to the use of the underlying asset during the lease term. And we now know those lease payments directly affect our opening lease liability, and in turn our right of use asset, because the liability is a core component of the right of use asset measurement. And you can see the first item the paragraph lists as a lease payment is fixed payments less any lease incentives paid or payable to the lessee. The guidance then points us to paragraph 842 105530, which defines lease incentives. According to that paragraph, lease incentives include both payments made to or on behalf of the lessee and losses the lessor incurs by assuming a lessee's pre-existing lease with a third party. Now, losses the lessor incurs from taking over an existing third-party lease will be rare in practice. An example might be that we want to break an existing lease with 2 years remaining, and the new landlord agrees to compensate our old landlord to take that obligation off our hands. Even though we never receive cash, the standard still considers this a lease incentive. But the much more common scenario, and the type we'll look at in a minute, will be payments made to or on behalf of the lessee. A very typical real-world example is a tenant improvement allowance. Lessees often need to customize space, and as an incentive, the landlord may cover part of those improvement costs, either by reimbursing the lessee or by paying contractors directly. Your natural instinct might be to net the incentive against the cost of the leasehold improvements, because economically it feels like a reduction in what we paid. If we spend $100,000 and the landlord reimburses $25,000, it seems intuitive to record a $75,000 leasehold improvement asset. But under US GAAP, that's not correct. We record the full $100,000 leasehold improvement, and the incentive is treated as a reduction of our lease payments under ASC 842. So let's wrap this up with one more look at the standard. Paragraph 842.2031 describes initial measurement for a lessee. We recognize a lease liability and a right of use asset, and relevant to lease incentives, that liability is based on lease payments not yet paid, which are reduced by lease incentives we expect to receive. And paragraph 842.2035 tells us that the ROU asset includes lease payments made at or before commencement, less any lease incentives received prior to or on the commencement date. And that brings us to our conclusion. When a contract includes lease incentives, the incentives we receive before or on the commencement date reduce our opening right of use asset directly. Any incentives we receive after commencement reduce the lease payments at the time we receive them, which then reduces the lease liability, and through that reduction, the right of use asset also decreases. So now that we've covered the theory, in the next episode, we'll put this into practice in our lease workbook.